I'm Stuart Gelfond. I'm a partner in the capital markets group at Fried Frank, and spent a lot of my time doing large capital raises for big companies. But one of the sort of neat things I've been doing over the years is a fair number of startup ventures. I did a lot of startup ventures about 10 years ago, including working when the Globe.com went public, which is sort of a forerunner of Facebook, and a number of other transactions. And the one thing that's always been an issue, at least in the States, is that the SEC has made it somewhat difficult to really raise capital in a public way if you're a private company. And the SEC has taken to heart and has tried to produce rules with the U.S. Congress push to really make public type capital raising easier for small startup companies, while they're still getting pushback from investment banks and others not to make it too easy. And they've passed a number of rules in what's called the Jobs Act, which is a series of rules that they've passed to try to make things easier, that so far has been relatively unsuccessful in the United States in terms of raising a lot more capital, but theoretically sounds better. And one of the things that the SEC has tried to do is pass rules on what everyone thinks of as crowdfunding, which means different things to different people. And let's talk about what it means here. In the US, which is different than the UK, every time you sell a security, even for a company that is listed on the New York Stock Exchange or on NASDAQ, you have to have an exemption from the US securities laws or a registration. You have to have a right effectively to sell securities. In other countries, once a company is listed on an exchange, then all future transactions sort of work. But in the US, every time you sell a security, you have to have something that lets you, under the US securities laws, and separately from state securities laws, sell the securities. And so what the SEC has produced is a rule that's going to allow crowdfunding in the sense that the SEC has defined it. And crowdfunding is going to be able to enable companies to raise up to $1 million in any one-year period, as long as they follow certain SEC rules through the internet with less information than the SEC would require on a regular way SEC offering, but would permit people to buy it without being as vetted as they have been in other transactions, and also permit free trading of securities. A lot of times in the US, if you buy a security of a small startup company, your ability to resell that security becomes quite difficult. And one of the advantages of crowdfunding is if someone puts in the money, they'll be able to sell rather simply. And so when people normally think of crowdfunding in the US, they've thought of things like Kickstarter. Kickstarter, you do a lot of things. You invest in a movie and you get a free ticket, or you invest in something and you get to go to the opening of the show. That doesn't really get subject to the SEC rules, which is why it hasn't been a problem, because you're not really buying a security. When you're getting a security or a right to share in the profits of what people are doing, then there has to be some exemption from that, and the SEC is in the process of passing these crowdfunding rules. They're still in the proposal stage, but I think it's likely that this proposal will get adopted somewhere close to what it has now. But that's why this is different than crowdfunding. So this is what we've already talked about, that under the U.S. securities laws, you can't offer or sell securities without having a registration or some exemption from the securities law. So I'm used to, I normally do these presentations sitting with these things in front of me. So basically, so the crowdfunding rule is an exemption to the securities laws, and it basically allows you to sell up to $1 million of securities in any one year. And one thing we'll talk about later is this is a single exemption, so you could sell $1 million under crowdfunding through the internet, and also do potentially other kinds of transactions and separate financing. So if you need to raise $3 million, you may be able to do $1 million in crowdfunding and $2 million in some sort of private placement transaction. It's going to be a little complicated, and we'll talk about that a little later. There's limits on the amount that each individual investor can purchase, and those limits are set out here and also in the speech. But it's basically going to be the greater of $2,000 or 5% of their annual income, or 10% of the annual income or net worth if someone makes over $100,000. So you're going to need to get a lot of investors together to get up to your 1 million transaction. But that's the purpose of crowdfunding. You're supposed to be able to sell these kinds of startup securities to the masses, because historically in the United States, all the people who made all the money in startups were the people who were already wealthy, and they were able to. If you look at who invested in, Facebook and Twitter and all those companies, it wasn't mom and pop getting access to these investments. And the SEC is trying to. Maybe it's not mom and pop. You probably don't want mom and pop investing in these things, but it is enabling the average person on the street to get an opportunity to this, subject to some limitations, because the SEC has an obligation to, or at least feels an obligation in these transactions to provide that there would be some sort of information. And so, you remember, it's $1 million in a 12-month period, so you're going to have to look back, probably look back and look forward. So if you do 500,000 now, you can do another 500,000 in the next year, but then every time you do a transaction, it's going to effectively count in the prior 12-month period and also count in the following 12-month period. Sorry, that's me beeping those beginning messages. But you're really going to have to follow it. But hopefully, if you're a company that does one round of crowdfunding, you raise $1 million, that in that, by the time you've finished those rounds, in your next round of financing, you'll be a further stage company and be able to go to traditional VCs or other types of financing. It's in all likelihood, if you're doing a second crowdfunding on the same transaction, that means you raised $1 million first year, $1 million second year. That may be a company that its likelihood of success is probably not as high as others going to the VC rounds. Also, when you're doing the crowdfunding, it's going to be a way to get your name out there, right? It's not just raising capital. A lot of what you're doing in a startup venture is obviously trying to get your name known to the public, and therefore this has an advertising kick as well. So like when if you watch Shark Tank in the United States, you see people, they go on, they actually don't get the money from Shark Tank at the time, but the publicity of being on Shark Tank enables them to raise money and do great things. And I think if you're going to be in these portals, people are going to at least read about you, see your name, and it's going to get you out there with greater publicity than you might otherwise do in sort of a private round of capital raise. So, and there are going to be very technical rules on how to check how much money people have, and how people are actually going to get that amount checked, and how to check whether or not people actually have these resources will be an interesting thing. But basically, there's going to be effectively transaction intermediaries that are going to be created who are going to run these sites. There's currently a number of transaction intermediaries running real estate sites, but they're doing something different in the real estate world. They're doing deals that are much bigger. They're doing $50, $100 million transactions, but they're not trying to fall within these exceptions. They're trying to fall within other exceptions of US securities laws, where they're raising money for real estate projects, which are not may or may not be securities, and they're trying to help find other people to do sort of private placements or other kinds of transactions. Here, the intermediaries are going to be being put together, and people are starting to do that to try to, they're the broker dealer trying to sort of vet the world, so that the people who are using crowdfunding to raise money, that's not going to be as much their responsibility. It's going to, the SEC has said, all right, we'll let you go to the public and find investors. We want someone to make sure that these people who can actually handle the investment, and that'll be the purpose of the intermediaries. And the funding portal will basically be the people or the entity that you're going to have to pay to sort of run the process for you. They're not going to make recommendations. They're really just going to be a site where you can find these investments and do it, but they're not going to say, come to our portal, invest in company X, Y, or Z. That's going to be up to the individual companies to get it, because otherwise the people would fight for the portal's recommendations. They're really supposed to be almost like a vetting source of people being able to get money. They'll obviously be registered companies, and they'll have to register with the New York Stock Exchange or FINRA, which are the U.S. organizations that govern broker dealers and things like that. So it's not going to be just anybody's going to be able to open up a website and suddenly say I'm now an intermediary. You're going to have to run through a process that's still to be created. I suspect, one of the issues is, given the size of the deals, which are $1 million each, how are people going to make money being the intermediary? If there are too many, there won't be enough deals for everyone to go along, but we'll have to see how it is. I think there'll be a startup cost in getting licensed and things like like that. But once if people are thinking that that's a business model, I know people are talking about doing that, but once the startup costs are out there, you'll be able to do it relatively easy. So and then this just sort of goes through that the intermediary is going to have to make sure again that the information is all out there and that the people who are investing are able to withstand investment. The issuer who's going to have to put something out there, it's not going to be sort of like Kickstarter where you just throw out a piece of paper. You're actually going to have to comply with certain rules that are going to be required by the SEC, and that's not been determined, but there's going to be limited standards of disclosure that people are going to have to come up with. That's different than U.S. general private placement rules, which, as long as you're selling to what they call accredited investors, which are people with $1 million in net worth or $250,000 in net income, you don't have to really give them any information. Of course, they probably will want information in order to make an investment, but you don't have to give them information. It's going to be scheduled information that is going to need to be made available, and it's all the information that sort of makes sense, right? It's your name, who are the directors and officers. People want to know who they're investing with, description of your financial condition, description of the business, how much money you're trying to raise, those kinds of things, which you're probably likely to have put out anyway, because if you're trying to raise money from people and you're doing it in a real standard, that's what you would do. It's going to be it's not intended to be solely for people who just have an idea and no business plan. You're going to have to put out some version of information. Describe the capital structure. And you're going to have to make these filings with the SEC. So there'll be someone reviewing your filings. I don't know whether or not the SEC is going to be regularly reviewing what people are doing. In the U.S., if you're a regular registered public company, a large public company, the SEC every 3 years reviews your corporate filings. I think that's a different, it's going to be somewhat different in what they're going to be doing in this situation. I don't think it's yet out there, but I would expect that, particularly at the beginning, the SEC is going to review your information, make sure you at least comply with minimum requirements, and have whatever financial statements are required. And if they need to be, in certain circumstances, audited by an accounting firm, that you have that, and that you have with here the balance sheet and your income statement and your statement of cash flows, and different years of requirements depending on how much capital you're raising. So if you're raising more than 100 and less than 500,000, you have to have financial statements reviewed by an independent public accountant who is sort of registered with the PCAOB and is able to do this for at least 2 years or your most recent period. Now, a review standard is actually a meaningful standard in the accounting rules. It's not an audit where they go in and check every one of your numbers, or in audit they're doing sampling. But a review is a serious procedure where a lot of what they're doing is looking at the numbers and they're making sure they seem reasonable in their circumstances and doing some spot checks and comparing it to other companies of that type until the numbers make sense in context. If you're going to have offerings more than 500,000 to $1 million, then you're going to need audited financial statements by a registered auditor of the PCAOB, and there'll be a cost to that. But it's also if you're a company trying to raise real proceeds, I mean, people are going to want to see those kinds of financial statements in any way, in any event, because it's they're putting in money. So if you're, it may be that smaller companies that are trying to raise $500,000 may not otherwise have spent the money to get an audit, because it's not cheap to get someone to put their name on the line. But something that if you're really intending to be a going forward concern, you're likely to spend that cash in any. But that is going to be sort of a slightly higher standard that may move some companies to only raise $500,000 or less. And there are going to be ongoing reporting requirements. As I said before, if you're a company that has done private placements in the United States, you're not required to continue to give people information. You only have to give people information that you've contractually agreed to provide. There's no ongoing requirement to do that. That's going to be different than if you're registered money under crowdfunding. You're not going to be required to provide people quarterly information, but you will be required to provide people annual information of the same type. So if you're required to do audits in your initial capital raise, then you're going to have to provide audit financial information. If you're required to do reviews, then you'll have to provide reviewed information. And that is an ongoing cost, but it gives the one good thing about doing an audit, it gives people some comfort that they're dealing with, you know, a company that's really trying to be out there, trying to make a name, and sort of has a long, hopefully a long future. So I still have 5 minutes, but I have another slide after. Even though this looks like the conclusion, I got another slide after this, so I'm trying to confuse everybody. This is sort of a new, you know, this is a new thing for the SEC, and we've talked to some of the people at the SEC on this, and we'll see in the next slide, Regulation A, and this is sort of a first attempt by the SEC to do something like this, enable people to register with the, and sell stuff through the internet without as much vetting. I remember, and to show my age, when the SEC first was debating whether or not to assume that if people had a computer and you emailed them the document or you made it available on the SEC website, was that deemed good delivery, and did you still have to send hard copy? And for years that was a big debate, was that what they call access equals delivery. And now that's just been the way of the law for the past 5-10 years, that as long as you put something and make it available, you can assume that people will actually get the information, and you don't have to hand deliver or make sure you send it to someone. So this is really, a first, sort of a first stage for the SEC. That $1 million can get reviewed. It's likely, if there's a lot of successes, then you'll see that $1 million being reviewed. If it winds up there's a lot of fraudulent transactions on this, you'll see the SEC stick to the $1 million and make it even tougher. I think that the SEC is under a lot of pressure as a government organization to allow people to invest, because the U.S. is afraid that everyone is going to go to other countries and it's going to be easier in London. There's a lot of competition for startup money. The U.S. recognizes that the future of the United States economy isn't on Wall Street, but it is in the tech world for the United States kind of economy. We're not, making clothes. We're building businesses, and we're doing technology and things of that nature. And so this is really the first start at what is likely to be a significant change in the SEC thinking about this. And if it goes sort of like the access equals delivery, 5 or 7 years from now there'll be another speech here, and we'll be talking about crowdfunding to 25 billion, or some version of crowdfunding. One thing I did want to cover is, since I know that a lot of people aren't here, there are other ways to raise money in the United States other than this crowdfunding that puts $1 million on your transaction. There are one is basically the private placement rules, and in the U.S. basically under what's called Regulation D, you can sell an unlimited amount of securities to people, so long as all the investors are accredited, which means that, as I talked about, have $1 million of income, or you can sell up to and include up to 35 non-accredited investors. The tricky thing is if you sell to non-accredited investors, the amount of information in order to comply with this exemption is a quite high standard, a lot higher than the crowdfunding standard, and what you need to provide to non-accredited investors in order to get the Reg D exemption. There's also a general exception for doing what you would call not a public offering or a private placement, but people get a little nervous if you're selling to too many people, that you would violate the rules. And then if you violate the rules in the U.S., one of the remedies is people have rescission. So you raise capital, you sell to more than 35 non-accredited investors, you do a big general solicitation, which you're not allowed to do. Then if the deal doesn't work out, people will have to put the stock back to you and get their money back. So you want to, it's important to comply with the rules. Another recent change that the SEC had is you used to not be able to generally solicit, which means you couldn't put ads in the newspaper, you couldn't do anything like that, anything of that nature. You couldn't go on talk shows. You're now under the current rules, which is a bigger change, I think, in many ways for people like me and people I deal with. You are now allowed to generally solicit, and that's what all the hedge funds are doing now, determining how you generally solicit. But if you do that, one, you can only sell to accredited investors, you can't sell to mom and pops, and you have a sort of heightened standard of you yourself checking that these people are really accredited investors. You can't just rely on a certificate that I have over $1 million in net worth. You might have to get tax returns, you might have to get bank statements and things like that. But you are now going to be able to, in the U.S., generally solicit and go, try to pitch your wares into the, over the internet or through other means, and that in itself may be a bigger change in the capital raising arena than will be crowdfunding. There's also what's now called Regulation A, and Regulation A is a registration form in the U.S. that has rarely been used, and that enabled companies. It was sort of a precursor to crowdfunding, but you could do deals for up to $5 million instead of $1 million, and in doing the $5 million, you can do that so long as you provide information which is halfway between nothing and what you're required if you're an SEC registered. I'll be about another 15, 30 seconds. Sorry, I was trying. I'm down the last section. That's pretty good.
It's a boxing bell. It's a bell. It's a bell.
Well, boxing bell. I got to go back to the corner and get my water, which I can use. So under Regulation A, those rules are now being changed to up to $50 million, which is going to potentially make this a much more useful activity. The rules are being written by an ex-Fried Frank partner, Karen Wiedemann, who used to be a partner here, she's now at the SEC, and the SEC really wants to make sure people can do that. Last thing, just to talk about, if you're raising capital in the U.S. and you hear about what's called the Blue Sky laws, those are the laws that basically each state has 50 sets of laws that also limit their own, that also limit the security. So just because you've done crowdfunding doesn't mean that New York State will allow you to do crowdfunding. And one of the challenges for the SEC is whether they're going to preempt state securities laws in passing the crowdfunding rules. And when we went down to talk to the SEC about Regulation A, to try to say if you're going to make people, you're going to give people federal preemption, but you're not allowed them under state securities law, it's not going to be all that helpful. So I apologize for going a minute over. If people have questions, I'll be around, or I guess we have a panel later to discuss this. Well, panel later.
Should we take some questions?
Take questions.
What do you foresee in terms of implementation of the crowdfunding rules?
I think that they said the rules have to be 60. The rules are proposed.
90 days.
There's 90 days for comments. There's the states are really against them because the states don't want they don't want crowdfunding over the internet. They want to be able to govern what the rules are and how it's all going to play out. I think the rest of the rest of the world is likely to be in favor of it. I think the United States is under a lot of pressure as the government and the SEC in particular in talking to them and really making capital raising a lot easier here. So I'd be surprised in 90 days that we don't have rules that are very similar to what we have now.
If you did, could you do a Reg D offering with a crowdfunding offering bolted on through one of these new platforms? So you could set it up on a platform, and everybody who's accredited would go through Reg D, and people who are not accredited would not.
It's funny. I was talking to someone about doing that today. Like how one of the tricky things is how would you combine a Reg D, which requires no general solicitation, with another deal where crowdfunding is ultimately the ultimate general solicitation. And I think the way you could do that, and one of these platforms may work, would be just that, because under the new rules, accredited investors, in order to have general solicitation, have to be really vetted. And some of these platforms, they may really be in the business of vetting people to make sure that they're okay. The problem is you're going to have to make sure that these websites and the portals are going to have to figure out a way that they can satisfy the SEC rules of getting people's financial information. And I don't know that people are generally going to submit their financial records, maybe they will, to these crowdfunding sites. But I think that's the way it would work, that you would have, you could have the same person doing both, and if they got an accredited investor who satisfied the standards of being in Reg D, you'd split up and do two transactions. And I think under the new rules, which permit general solicitation, it should work, although it's certainly not been tried. That's sort of, I was talking about a couple of partners today before I was doing this about what might work.
That would kind of be a backdoor way to advertise a Reg D.
Right, but you would have to. You're allowed to backdoor advertise Reg D offerings as long as you vet the investor at a higher level than previous. And so that's somehow whether these portals are going to have the capability and people will be comfortable. That remains to be seen. We haven't seen who these portals are going to be and how they're going to work, and how they're going to basically know in any event that the individual investors work. And it may be that you'll call them into the portal, and the portal will actually have people behind it who will vet the information. There'll have to be something to do that. But I agree that because crowdfunding $1 million is interesting at some level, but it's a lot more interesting when it's combined with something else. That's why I have the last slide.
Thank you very much, Stuart.
Thank you.